Good morning and welcome to Stock Market Today. It's Tuesday, October 1st, 2019. I am your host, Dan Russo, Chief Market Strategist at Chaikin Analytics. You can find me on Twitter at DanRusso_CMT. Stock Market Today brought to you today and every day by Chaikin Analytics. Head over to ChaikinAnalytics.com/today, where you can sign up for a free email. It gives you daily stock ideas for you to consider. Hits your inbox every trading day before the market opens. So welcome to the final quarter of this decade. U.S. equities finished higher in Monday's trading, but ended off the best levels of the day. Tech and healthcare outperformed, while energy and financials lagged. Treasuries were little changed, reversing earlier weakness. The dollar was stronger against the yen and the euro. Gold finished down 2.2%, and WTI crude ended the day lower by 3.3%, actually settling lower than before those attacks on the oil field in Saudi Arabia. Again, your outperformers, tech, healthcare, and add discretionary to the mix. Underperformers, energy, financials, utilities, and REITs. As we get to the desk this morning, S&P futures are up 20 basis points to begin the new month and new quarter. Asian markets were higher overnight, and European markets are trading mixed here this morning. Treasuries are under pressure, sending yields higher. Dollar is stronger versus the yen and also better against the euro. Gold is pretty much unchanged to start the day, and WTI crude is rallying a bit, up 1.1%. And as we look at the technical structure of the S&P 500, not a ton has changed here. We did close the month and quarter on a bullish note. As I said, support remains in that 2,900 to 2,950 zone, and resistance is in the area between 3,000 and the July highs near 3,030. What we are watching closely as support continues to be tested is the RSI. We've been pounding the table on this one for quite some time. As long as the RSI holds above 40, which is the lower bound for bullish ranges for this indicator, odds favor an upside resolution to the current consolidation, especially when you add in the fact that Chaikin money flow is putting in a series of higher lows and remains bullish. So the indicators point to potential upside resolution for the market here as long as we continue to hold above that support zone that we've been highlighting. It's been tested a couple of times over the past week, but so far proving its worth as a top end of the support zone at 2950 continues to hold. Turning now to our market in a minute, going over what I'm writing about in my note for Chaikin Analytics clients today. Equities move higher on the final day of the quarter. We touched on that. Actually starting to see some signs of life in financials on a relative basis. And we'll take a look at that a little bit later in the show. At the same time, defensive sectors continue to outperform as technology tests key relative support. We'll take a look at both of those dynamics a little bit later as well. Futures do point to a higher open to start the new month. And as we dig into the major indices and look at them from a power bar perspective, right, how many stocks in each of these indices have bullish, neutral, or bearish ratings, we can see the Dow still skewed in favor of the bears. 6 bearish or very bearish stocks for 4 bullish or very bullish stocks there. S&P 500 taxed on 50 basis points yesterday, 122 bulls to 83 bears. So some improvement day over day in that metric. NASDAQ was an outperformer, but the ratio still skews bearish ever so slightly. Small caps, even though they were up, they underperformed on the day again. 597 bulls, 369 bears. Nice rally in bonds to send yields lower, although that is being unwound here this morning. And tech was the standout at the sector level, up over 1% yesterday. Evenly matched in terms of bulls to bears, 10 to 10. So according to the Chaikin Power Bar, small cap stocks and large cap stocks are somewhat bullish. Across the board, though, the major indexes are mixed. Let's hit our stock of the day now. Again, our stock of the day is auto-generated by our algorithm based on the power gauge rating, and Orasure Tech, ticker symbol OSUR, has a very bullish rating. Stock closed at 747 yesterday, up 1.63%. So some nice outperformance, and that power gauge rating is very bullish due to very attractive financial metrics, very strong earnings performance, and very strong price volume activity. So the 20 factors, 5 in each of these 4 categories, give us that very bullish rating. Trend is strong, industry is strong. So when we see that, type of name we want to consider. But as we dig in and do our analysis, we should quickly realize that we're doing nothing more than adding this stock to a bullish watch list because it's an underperformer relative to the SPY as it has been for the past 12 months. So the market and the model are not in agreement, as the very bullish rating is met with underperformance. At the same time, we're not quite oversold yet based on our indicator, and money flow is mixed at best. So what I see here is a stock that's potentially trying to carve out a bottom, but it's still a bit too early to get involved or really get excited on the bullish side of the portfolio. So what I like to do in these situations is add the stock to a bullish watch list. And if this relative strength starts to improve and money flow starts to improve, then it becomes more interesting to me. OSUR going on the bullish watch list here this morning. Turning now to the sector tracker. Looking at the movement of the major sectors over the last 5 days, you can still see that we have that very defensive feel at the top of the list, right? Staples up over 1%, utilities up over 1% over the past 5 days. Real estate is positive as well. This is much the case, right? Even going back further in time, 12 months, 6 months, 3 months, these three sectors have been and continue to outperform the broader market. Tech, materials, industrials, and discretionary are middle of the pack. And then financials, healthcare, comms, and energy round out the laggards. Energy just continues to go lower. Fundamentals never changed there. We had the big spike in oil. Some people started to get excited about energy, but the fundamentals for the group, at least as the way we view the market, did not change, and the group has resumed its downtrend on an absolute and relative basis. We are going to touch on financials a little bit later in the show, as I said. Now, the industry in focus today is one that we've been bearish on. We've been avoiding the pharma services, and for good reason. Over the past 6 months, this group has underperformed the S&P 500 by over 16.5%, 16.59%. And the power bar ratio, which measures future potential, is still weak, right? 14 bearish or very bearish stocks, only 5 bullish or very bullish stocks, earns it a rank of number 19 of the 21 subsectors we track, and it's moved down 4 slots over the past week. So some of the indicative names there, all with very bearish Chaikin Power Gauge ratings, Axsome Therapeutics, AXSM, Zogenix, ZGNX, and Wave Life Sciences, WVE, all with very bearish ratings. So names you certainly want to avoid, or if you do trade to the bearish side, maybe see if they set up in the options market to take a view to the bearish side of the coin. But as we look at the fund here, XPH is the pharma services ETF that tracks this group. We can quickly see bearish ETF power gauge rating and a weak trend as the fund trades below a declining long-term trend line. Look at the underperformance. This group has been underperforming the market for nearly a year. It was last late October, early November when that underperformance really started to kick in. And throughout that time, we've seen a lot more bearish money flow than we've seen bullish money flow. Fund is currently nearing an oversold level. But the trend here is decidedly bearish, so the technicals are bearish. Power gauge rating tells us that the fundamentals are also bearish, especially when we take into account this power bar ratio. So pharma continues to be an area of the market that we would like to avoid or potentially look for bearish opportunities when they present themselves. So staying away from pharma for now. Taking a look at what's trending now, yesterday's S&P 500 movers and shakers, our gainers and losers. On the winning side of the board, Jefferies. No real news yesterday. They did report last week. Stock up 3.6% yesterday. L Brands up over 3% as the retail group was generally positive yesterday. FLR, a $1 billion modification to a current contract, sent that stock higher by over 3% on the day. Lodging names were strong yesterday. Marriott takes part there, up nearly 3%. No real news on the line to send that stock up 2.9% on the day. Loser side of the board, top three here, levered to the declines in oil. National Oil well, Varco down 3.8%. Again, remember, oil was down over 3% yesterday. BHGE down 3.5%, and MPC down 3.5%. Remember, MPC does have an activist investor involved there. NetApp was reiterated underweight at Morgan Stanley. That stock was lower by 2.6% yesterday. No real news on Macerich MAC to send that stock down by 2.23% on the day. So very much you can see the thematic at play with the energy names underperforming, with oil beginning to move lower again. We just keep saying it's an area of the market that that we want to avoid. Turning now to some of the key charts that we're looking at, what has our attention today. Every Tuesday in my note for Chaikin Analytics clients, we look at relative strength of the sectors to get a sense of how the sectors are rotating, whether current trends are going to remain or are likely to reverse. And today was kind of interesting because we're starting to see some reversals in key areas of the market here. So first, what we're looking at is financials on a relative basis. So this is the XLF, the select sector SPDR for financials relative to the S&P 500. And you can see it's been a clear downtrend since February of 2018, right? Remaining below a declining 200-day moving average for much of that time. And it was a bit of a bifurcation here. A lot of the weakness in the financials due to the banks with falling interest rates. I will note that insurance was an area of the financials that had performed well and continues to perform well. But now we're starting to see a potential change here as a relative base is beginning to take shape. The ratio has moved above the 200-day moving average and broken through this downtrend line. And what's interesting to me is that on this last test of support back here in late August, the RSI did not become oversold. It held above 30 and now appears to be shifting into bullish ranges. So we have a momentum change taking place for financials on a relative basis. Are we out of the woods just yet? Not quite. But there are signs of life in the financials beyond what we're seeing in the insurance group. And that's kind of interesting because interest rates are still moving lower. So we'll see if this can start to get some legs, but signs are starting to point to at least a change from a downtrend to a neutral trend, and a breakout here would be encouraging. On an absolute basis, we could see a nice steady uptrend for the group, but that uptrend did not keep pace with the overall equity market, which is why the relative strength didn't perform as well as it did. So starting to keep an eye on financials. As a matter of fact, one of the names that I'm highlighting in my note today is TROW, TROW, as a potentially bullish idea for our clients. Now, defense does remain leadership. Here we're looking at XLP, the consumer staples ETF relative to the S&P 500. And you can see it has broken out of a consolidation and above the 200-day moving average for the ratio. Pull back to test support and now beginning to work higher once again. And I'm using consumer staples as an example here. I could have very easily looked at the REITs. I could have very easily looked at the utilities as well, right? Very similar dynamics from a technical perspective. If we look at the RSI for this ratio, we can see it's starting to make a series of higher lows as it begins to shift and hold within bullish ranges. And at the same time, on an absolute basis, XLP is trading at a new all-time high. So defensive areas of the market are outperforming. I highlighted it earlier. It's across time frames, 3 months, 6 months, 12 months, even the 5-day that we've been looking at. So when we're starting to think about where we want to look for ideas in the market, these are a great starting point. Look at the holdings of XLP. Look at the holdings within the utilities and the REITs ETFs, and the ones that set up well on an absolute and relative basis are the names that are likely to outperform going forward. And then finally, technology is testing key relative support. Here's XLK relative to the S&P 500. And you can see we've gone into a bit of a consolidation here. We had a breakout, and now we're testing that breakout level, still above a rising 200-day moving average. So the trend does remain bullish. But to me, for investors who are focused on growth and the growth theme, this is a big chart to be focused on, because if this support level gives way, we're likely to continue to see a rotation out of the growth areas of the market. And more importantly, tech is the largest weight in the S&P 500 at about 20%. Now, the RSI is middle of the road, confirming the price action on a relative basis. And on an absolute basis, you can see that tech is in that same consolidation. So tech is clearly at an important inflection point. Bullish investors want to see this consolidation resolve to the upside. Well, if you're a bearish investor, you would welcome a breakdown here. So that's going to wrap it up for today. Just a reminder, you can head over to chaikinanalytics.com/today, where you can sign up for that free email. A lot of the content for this show comes out of that email. some daily stock ideas for you to consider, right? Do your research and work on them a little bit further. Hits your inbox every trading day before the market opens. I will see you all back here tomorrow. Have a great day, everyone. Happy Tuesday.